Good afternoon, ladies and gentlemen. My name is Marta Kozlowska, and I am the Development Director at the Energy Institute. I'd like to warmly welcome you to this webinar on behalf of the Institute and the World Petroleum Council UK Committee, and at the same time thank Shell and Deloitte for their kind sponsorship support. As many of you will know, the Energy Institute is an independent network of professionals following the whole energy system, working with our members to tackle urgent challenges and energy needs of a growing global population while addressing the climate change urgency. We bring together expertise so that energy can be better understood, managed, and valued. And the topic of today's webinar is very timely, as the energy industry from oil to renewables has been hit by turbulent challenges. So I am sure you will enjoy an informative and insightful discussion. We have over 500 participants registered, which certainly speaks volumes about the importance of what we are going to hear and the quality of our presenters. With this in mind, I would like to welcome all our speakers, and in particular, I have great pleasure in introducing the chair of the first session, Fellow of the Energy Institute, Wim Thomas. Wim is the Chief Energy Advisor at Shell and also chairs the UK Committee of the World Petroleum Council.
Yes, thanks, Marta. So welcome everyone on behalf of the World Petroleum Council, the UK, the WPC. In discussing this webinar, financing the aspects of the energy system in transition. Just a bit of background, before Corona, you talk about before and after Corona nowadays, but before Corona, it has been usual form for a mini symposium at the excellent facilities at Deloitte in London, where we could also do a lot of networking, but I'm afraid we have to do with the webinar today. But I think quite a few participants will have got used to it now as a new normal and find it very effective indeed. So maybe then the second point I'd like to make is just to briefly put in context how this webinar works. We're part of the World Petroleum Council, as I mentioned, and once in 3 years we organize a big congress. It was supposed to happen this year in Houston in December, but that has been postponed because of Corona. It will take place next year, and this webinar is still part of it, but we thought not to postpone it and carry on as normal. So very quick introduction then. Really the bulk of the program is around the keynote speech of Michael Waldron from the International Energy Agency, followed by a panel discussion of distinguished participants in the energy industry and actually dealing with this energy transition, the financing of that from a day-to-day basis. So with no further ado, let me introduce the keynote speaker today, Michael Waldron of the International Energy Agency. He is head of the investment team and project leader of the World Energy Investment Report. This report is hot off the press last week and forms the basis of his keynote. I think his team has been specifically looking at the cross-cutting trends in energy financing and the implications of energy investment for meeting energy security and sustainability goals. So hence an excellent background for discussing the main theme of this webinar. So Michael, over to you. Michael, we're not able to hear you. I can't hear you, I can't see you.
There we go. I think that works. I lost my my controls for a second, but I found it.
Okay, I can hear you now. Great.
Okay, great. Well, thank you very much, and hello to everybody. And as Wim said, yes, this is a report which is very hot off the presses. It was released last Wednesday. This is the 5th edition of the World Energy Investment Report that the IEA has produced. And in an ordinary year, we would be talking about what happened in 2019, so what happened in the prior year. But of course, 2020 is no ordinary year. So this year, what we've done is we've tried to piece together the latest available investment data, announcements from companies, governments as of mid-May, supplemented by interviews with industry figures and investors to try to understand or put together the picture for energy investment in 2020. So a lot of this report or a lot of this presentation is going to be based around what we see going on now, but then also trying to quantify the potential implications of this 2020 investment picture and how this would affect the energy system going forward. As requested by the chairs, I've made the focus, at least in the second half of the presentation, more on the financing side, so we can kind of draw out some of the insights in terms of what we see in financing. But I would convey that the structure of the report is quite broad and quite rich. So we have a number of pieces of analysis related to the entire fuel supply sector, the power sector. We look at energy end use and efficiency investment trends. Like I said, we look quite in depth at financing and funding trends, but also look at spending in research and development and on technology innovation. So I would encourage you to check out, and I think there's a link to the report at the end of my presentation. So without further ado, coming to the main results, let's see how fast this will go. There we go. So before coming into this cycle of the investment report, we had expected actually a fairly good year for energy investment. So for the first time since 2014, we had seen notable growth, or we were expecting notable growth of about 2%, quite broad-based in fuel supply and power and in end use, although 2% gain is not a lot, considering the fall-off investment that we've seen in prior years. Now, what that 2% gain has turned into is a fall of 20%. In this fall, I'll describe more across the different sectors in subsequent slides, but it's worth noting for now that investment cuts are particularly concentrated in regions which are dependent, or regions where you see relatively high shares of oil and gas production. But investment cuts are concentrated in many parts around the world. So even including in China and in Europe, where these areas may matter less than in some places like the United States and in the Middle East and North Africa. Now, when we're looking at the different sectors, the first striking finding that we have in the world energy investment is looking at the spending that consumers are making on energy. So typically about 90% of spending on energy is concentrated in oil and gas, or in oil and electricity. And these are the revenues that these companies would expect to get. When we're looking at 2020, we're actually seeing expectations of a sharp drop in revenues, in particular in the oil sector. So a drop on the order of some $1 trillion, but also a bit of a fall off or a bit of an edge downwards in electricity, a sector whose revenues are normally quite stable over time. This is a result of the sharp fall off in demand that we've seen in energy across many of the sectors, but also the fall off in prices that we've seen in sectors like electricity. This is supplemented by, in some cases, non-payment or deferred payment by consumers. And the results of these revenue shortfalls are that companies essentially have weakening balance sheets and reduced expectations for investment ahead. Now, that's one area which feeds into the investment cuts. This sort of financial proposition, or this changing financial situation for companies in the wake or amid changing expectations of demand. But investment cuts also result from sort of the practical implications of lockdowns that we've seen in many parts of the world. So in terms of project development timelines, sometimes being shelved or sometimes being pushed back as a result of real constraints in terms of labor and equipment. The graph on the right gives you a sense of where we see these different cuts by sector. By far the largest cuts we expect in the oil and gas industry. The negative, or the minus 1/3 investment that we see in oil and gas also masks some deeper cuts. So for example, in the US shale sector, we see cuts on the order of about 50% in terms of CapEx for 2019. with different parts of the industry affected in different ways. There's particular vulnerability around national oil companies, for example, and even a number of the sort of larger players, larger integrated players have announced CapEx cuts on the order of 20, 30, up to 40%. So very broad-based cuts in oil and gas, but we're also seeing cuts in other sectors. The power sector is relatively less affected. I'll talk about that in a few slides, but we're also seeing reductions on a double-digit nature in coal supply, but also energy end use and efficiency, reflecting revisions or reassessed expectations for economic activity when it comes to the construction of buildings or the sales of vehicles or industrial activity. Now, the next few slides are going to focus on the situation in oil and gas and the implications. I can turn the slide here. There we go. And like I said before, the cuts are quite broad-based across a number of the oil and gas players, both in terms of the majors, but also national oil companies. Independent oil companies are particularly hit hard in this, and no company and resource type is immune to the cuts. As I said before, Shale is hit particularly hard. And one big difference between this downturn or this revision to capital expenditures compared with 5 to 6 years ago, during the 2014 to 2016 downturn, there was scope for oil companies to cut costs as a way of reducing CapEx, but also sustaining activity. This time around, this scope is more limited. So a lot of these CapEx cuts are not feeding into necessarily cost reductions, but feeding into activity reductions, which are evident more on the next slide. The chart on the left gives you our initial expectations for upstream spending investment, and then the new estimate. And if we translate this into barrels per day, so if we translate this into lost production, we tried to assess what would be the implication for 2025 oil production of 1 year of lower investment. And this results in a fall of about 2 million barrels a day. But the risk is potentially if investment stays lower for longer. So if investment stays lower to 2025, the production shortfall is potentially more than 8 million barrels a day. So a sort of wide delta in terms of implications for oil production, depending on how fast investment comes back. If it does come back to the extent that it was in 2019, which also raises questions around whether demand also rebounds faster than expected or faster than new production can rebound in terms of the rebound in capital expenditures. Now, turning to the power sector, as I noted before, we also see cuts of about 10% across the power sector. But again, if you're looking at the different underlying sectors, there's some differences here as well. Renewables remain relatively resilient compared to fossil fuel power. So fossil fuel power declines by about 15% from 2019 to 2020. A lot of this is concentrated in gas, but also coal as well. What's quite striking is if you not just take the trend from 2019 to 2020, but you look at the cumulative changes that we've seen over the past 5 years. So certainly investment in coal power has gone down by quite a bit, but also investment in key flexible resources such as gas power, and particularly investment in transmission and distribution are lagging behind. So one of the messages we've given from our report is that overall investment in power sector flexibility in those items which are necessary to support sustainable and reliable power systems is increasingly at risk because of the cuts. When we're putting together and looking at kind of the broader clean energy universe, so looking at all the different technologies which would be needed to support clean energy transition, this ranges from renewable power to renewables and heat, to energy efficiency, to also things like carbon capture and storage. And here, for the past 5 years, we've seen a relatively stable trend in terms of spending and investment. So clean energy investment has kind of been stuck around the 600 billion level. At the same time, we've seen some very good cost reductions occurring in some technologies. So despite the level of investment, we've actually seen increased deployment and increased capacity in some parts of the energy sector, particularly renewable power, but also things like electric vehicles. Now, the implications in 2020 is that compared to the fossil fuel sector, the decline in clean energy investment is relatively less. So this gives you an interesting result where the share of clean energy in investment actually starts to rise, as opposed to being stuck at around the sort of 32, 33%. It starts to rise towards 40% in 2020. But this is a bit of a mirage, or it's a bit of a temporary thing, because it's very much due to the weakness that we've seen in fossil fuel investment rather than the strength that we've seen in clean energy investment. So again, the results continue to raise questions over the momentum for investment in clean energy transition. And overall, the absolute level, even though the shares have risen, the absolute levels remain far short of what would be required to meet a more sustainable pathway, such as under the IEA Sustainable Development Scenario. Now, the ways out of the crisis, or the pathways ahead, will in large part depend on the response of governments, but also the response of different companies and investors in financing the transition. So one thing we looked at in response to this type of question was who are the owners, or who is the dominant ownership of the new energy investments that were coming online in 2019, to give you an indication as to where the sort of major actors are in terms of the decision making going ahead. So we looked at the share of government ownership in different energy sectors. So not just in the total, but also in things like renewables and electricity networks. And we find that by and large, clean energy technologies, renewables, energy efficiency are much more originated and developed by private actors, whereas state-backed actors, state-owned enterprises play much more of a role in things like fossil fuel generation, oil and gas supply, and also electricity networks. But there's an interesting implication in terms of the division or the difference between advanced economies and developing economies. So of course, in developing economies, state-owned enterprises play a much bigger role. And this suggests that looking forward in terms of investment trends, what happens to state-owned enterprises, and indeed what happens to the sovereign governments in terms of their ability to finance those state-owned enterprises, will have a big impact on the investment trends that we're seeing in the wake of the crisis. Now, as I said before, we tried to focus, at least in this presentation, a bit more on kind of the financing aspects of the different parts of the energy system. And so the next few slides will give a bit of an overview or a bit of a flavor as to what we're seeing going on in debt markets and in equity markets. And then we'll get into some of the sectoral trends that are connected to this. So one thing we looked at is we looked at changes in the weighted average cost of long-term debt for different energy companies and different governments to understand how this was changing as a result of the crisis. As you can see from the chart on the left, for a number of actors, debt costs edged upwards, but yet on a historical basis, they still appear quite manageable. So they've gone up maybe 100, 200 basis points for some companies. But this is not sort of outside the realm of where it's been in the past 5 years. Part of this is related to the fact that a number of the companies on the chart on the left are in advanced economies, and in advanced economies, we've seen benchmark rates continue to fall, particularly in the United States, Europe, and also Japan. But in other parts of the world, so in emerging economies, in some emerging economies, we've seen benchmark rates go up, reflecting increased government and sovereign risks around those countries and increased borrowing costs. This hasn't been universal. So for example, in India, we've actually seen benchmark rates go down a bit, but there's a risk of higher cost of capital, particularly in emerging economies, translating into energy investments on the debt side. We've also looked at trends in equity investments, and this particular chart is a bit more of a specific look, and it's an analysis that we developed jointly with Imperial College, their College of Business. And what we wanted to understand is over the past 5 years, how have renewable power companies performed relative to fossil fuel companies? So to try to understand what is driving the investment allocation decisions of institutional investors and what stock markets are telling us about the relative financial performance between these entities. And so this is a look which focuses more on advanced economies. So it's looking at Europe and the United States. And an interesting message from this, which is not apparent from the chart, is that over the past 5 years, equity portfolio focused around renewable power has actually outperformed the portfolio around fossil fuel supply with lower volatility. So the returns were higher, but also the returns were higher on a risk-adjusted basis, albeit a lot of this sort of gain or advantage for the renewable portfolio has come in the past year to a year and a half. Interestingly, as well, if we're looking at during the crisis, we've seen the renewable power companies hold up relatively better than the fossil fuel companies as well. In part, this reflects some of the sort of policy-based revenues or the contractual revenues, which are underpinning a lot of renewable power investments, but it also affects some of the uncertainty and some of the risks that investors see around investing in fossil fuel supply and in oil and gas companies in particular. To note that also the renewable power companies were generally in line with the market, so they weren't strongly outperforming the market. But one of the things that we hear from institutional investors is that it's still challenging to invest in a sector like renewables because of the scale and the liquidity associated with the investments and the securities. A couple interesting sectoral trends that we're looking at, kind of unpicking a bit some of the high-level trends that I've given before. Some questions over how the financial strategies of oil and gas companies will evolve, and I'm sure this will be taken up in the discussion. So we've looked at the dividends being paid out by these companies. Of course, for the majors, dividend yields, high dividend payouts, share buybacks have been really important parts of their financial strategies over the past few years. And indeed, during the previous downturn, they had borrowed in order to keep paying dividends. But what we find is that in the current crisis, perhaps things have changed quite a bit, and that the sustainability of the strategy is increasingly being called into question. This is reflected in the chart on the right by the dividend coverage ratio, which we looked at, which only shows the first quarter of 2020. So it doesn't show the sort of full extent of maybe some of the financial stress that these companies are under, but also the reflection that a couple large oil companies have announced sort of unprecedented cuts in dividends, while a number of majors have still tried to turn to the debt markets to borrow. But there are questions over how sustainable this practice is over the long term, particularly with weakened balance sheets. When we're looking at financing issues more in the power sector, so kind of keeping with this dichotomy between oil and gas and power, an emerging question for us is how well things like project finance structures will be suited to support power investments in the wake of the crisis. So most power investments are based on balance sheet. What we've seen is that, but out of all the energy investments, project finance structures play the biggest role, I would say, in power compared to other sectors. And what we've seen in 2020 is a sharp fall off in project finance transactions after several years of growth. And this growth was reflected not just in geographical diversification outside the United States and Europe, but also diversification more towards renewables. So project finance being used more towards the financing of solar PV and wind on a global basis, and as a way of incorporating more debt into project capital structures and lowering the cost of capital. What we've seen is with the sort of risk aversion that we've seen in financial markets, and also a fall off in transactions, that perhaps there may be increased reliance on balance sheets by power companies, by renewable developers for financing assets in 2020. But of course, the weakened positions of these balance sheets raise questions over their ability to do so. And then finally, I will try to conclude by highlighting a cross-cutting trend in finance, which I also believe is going to be part of the discussion. And this relates to this kind of broad push or broad interest by capital markets and sustainability, so the sustainable investments. And what we did in this year's investment report is we did a bit of a focus on institutional investors and also sustainable finance. And we looked at some of the broad drivers, and we also looked at some of the financial flows associated with this. The analysis, I think, raises more questions than provides answers, but hopefully provides some food for the discussion on the panel that will follow. The charts here basically show you the engagement by investors in terms of proposing climate-related resolutions for oil and gas companies. So you can see that these have gone up by quite a bit over the past decade. And what we see is we see kind of three broad forces that are shaping sustainable finance. One is this, what you see in the charts, a broad push by investors and regulators around engagement and divestment initiatives. Another is the push by regulators, but also private sector in terms of disclosing information so that investors and banks can undertake assessment of their portfolios for climate-related risks. And the third is efforts by various initiatives, a lot of these government-led, to better classify sustainable investments. So things like the EU taxonomy, which are trying to better give you a guide, give investors a guide to whether their investments are sustainable or not for meeting long-term sustainability goals. And one of the effects of this is that we've seen an increase in financial flows in sustainable investments, particularly in terms of sustainable debt. So these charts show you the rise of green bonds, but they also show you the rise of other types of sustainable debt investments. These have grown about tenfold since 2014, but and most of the uses are going towards things like renewable energy, energy efficiency, emissions reductions initiatives by the different companies. But a couple caveats here is that, first of all, despite the very strong growth, this sustainable debt market only represents about 5% of annual issuance. A lot of this is occurring in advanced economies. You do have green bonds being issued in China, for example, in India, but the penetration into emerging economies has not been as robust as you see in Europe and the United States, for example. And then the last caveat associated with this is that we've seen quite a big growth in the financial flows, but this hasn't necessarily resulted in an expansion of the pie for capital expenditures done by the companies for renewables and energy efficiency. So renewables and energy efficiency haven't grown by tenfold since 2014. Part of this is also related due to falling costs. But it also relates to, or it also sort of raises questions as to the role of sustainable debt and how this can have an impact on the cost of capital, but how it's used perhaps more in refinancing than creating new projects. So this can be something that can be taken up a bit more during the panel, perhaps. So looking at the conclusions, I mean, I won't read through these, but I'll simply note that the scale and the speed of the pandemic has changed energy investment by quite a bit in 2020 across all the different sectors. It's especially shaken the oil and gas industry, especially shale, but at the same time, we're not seeing the increase in clean energy investment that you would need to see to give us confidence that the world would be on a pathway for lasting reduction in global emissions. And in terms of the financing, financial strategies for all energy actors are affected. And we see that capital allocation decisions are increasingly colored by sustainability concerns. But as I noted in the chart with the ownership, a lot of this is occurring in kind of half the world. So you also have the other half of the world where state-owned enterprises are playing a major role in energy investments. And here it raises questions over the role of investors in these situations. So with that, I will conclude and I think turn it back over to Wim for the discussion.
Thanks, Mike. That's very good and very well set up for actually have these discussions. And indeed, I think the question is, can we turn off the beeps? Will be very helpful. But just before we go into the Q&A with you, I'd just like to do a Menti poll with the audience. And basically saying, what does the audience think? How do you see the risk of returns change in the oil and gas and renewables? And just very briefly, better now for renewables, but will it rebalance in a couple of years, or will it always remain best for oil and gas, or actually will renewables win in that sense? So is only one. Okay, we see now the people coming in, and we need a bit more in the poll. Let's see what's going on there. Okay. So we're still getting in 35 people over about 500 people logged in. So hopefully we get some more coming in. But it looks like that the poll is here is that will move in favor of renewables over the investment cycle in the future. That's a very optimistic view, and we'll no doubt discuss that further. I'll give it a bit more time. I think, well, let's, I don't know if this can run in the background and we can come back on that. But also there will be, after this round, there will be an opportunity for everyone to just have real questions, submit your questions to the panelist, to Mike, and I will try to filter through what it will look like. First of all, but while you do that, audience, then I'll just let me kick off a question actually linking into this risk to return question on the poll. And so, Michael, what do you think? Given I think today is very apparent optimism in the markets. Say how the COVID crisis will evolve. It seems to indicate an expectation of a sharp V-shaped recession, at least in oil terms, and then recovery into the second half of this year. But then I look at your rather sobering observation that investment oil and gas, but as well as renewables, are just basically insufficient for your sustainable, even for your sustainable development scenario. So you're not doing right for that scenario. So a bit question then around how does the IEA look at the future of energy security? Because of course, if we are running low on oil and gas, but we haven't stepped up sufficient on the renewables and vice versa, I think the world may come to perhaps what they call a supply-deprived energy transition, which would then trigger another super cycle. We had a few, of course, we used that in oil and gas. But will it begin a new super cycle for oil and gas, or will this time just be renewables? So it's quite a holistic question, so feel free to pick up what you would like from that.
Yeah, thank you, Wim. I mean, I would note, and perhaps I could have set out a bit better some of our working assumptions for the world energy investment. So the investment estimates are based more on a U-shaped recovery than a V-shaped recovery. So it assumes a decline of GDP about 6% this year. So it corresponds to the IMF's lower for longer case. So at sort of first glance, that's a good reason for the bearishness in oil and gas, but also renewables as well. So it obviously with a faster rebound in demand, you would see more of a pickup in prices, particularly if supply is constrained. But right now, our working assumption is more for a slower recovery rather than a rapid one. One thing we looked at in the investment report, and this is more sort of concentrated in the overview, is we have done some benchmarking to the investment data versus what would be required under different IEA scenarios. So looking at the IEA stated policies scenario, which essentially reflects the direction of travel of the energy system now. But of course, what now is constantly under change. So this was a scenario that was put together for last year's World Energy Outlook. But if you sort of took that as the uppercase, or if you took that in terms of the demand increase potential, if you just made that comparison, then the 2020 investment would be falling, at least in oil and gas, would be fall short of that needed in the stated policy scenario. That said, where investment would need to go would be more up around 2019 levels, at least in oil, and higher in gas. But the question is what that sort of trajectory or what that sort of adjustment looks like going from here to a possible world of stronger demand growth. And it's tough to see right now that we would simply go smoothly back to a world of increased demand growth, although of course our oil markets report gives you a much more near-term look, and also has a rebound in demand that is forecast there. But in terms of investment, this is one of the reasons why we did this analysis of capital expenditures being lower for longer, to try to understand the implications for 2025. So every year that investment continues sort of at that lower path, at least in oil and gas, this raises this question, or it raises the risk of a potential market tightening, but probably more so in terms of the volatility that you may see as the market adjusts, because the traditional levers of adjustment, both on the supply and the demand side, are not there in the current crisis. But of course, that can change with changing economic conditions. On the renewables side, I mean, I would say it's slightly less, it's less tied to demand, and the sort of trajectory or trends that we've seen from the power companies is that many of them are maintaining spending on key projects. A lot of these are large projects that have been in the works for several years. So for example, things like spending on offshore wind and hydropower actually increase in 2020. They don't decrease. Where we see a lot of the renewables investment being cut is particularly in things like distributed solar PV, which responds very much to consumer balance sheets and consumer spending, but also in these sort of shorter lead time projects, smaller projects. You could put utility scale solar PV under this as well, but it's likely the smaller projects or the projects being undertaken by smaller developers, which are more at risk than the larger utilities. But that said, I mean, the sort of structural underperformance of renewables investment is something that we've said for several years now. So it's not a new message coming out of this report, but one which is, of course, exacerbated by the current crisis.
Thanks, Mike. So it's a very diplomatic answer. So really committing yourself to the oil price spike. Some people postulate or not. That's fine. And I'm just picking up a few themes from the audience here on the role of actors, state actors in particular, but also on renewables. So maybe it's good to, probably it's linking to one of your slides, which showed a lot of what I call meager uptake in the first quarter of green investments compared to, say, the full year before. And it doesn't look like it is on schedule really to surpass last year's investments. So how do you see that signal in context of the call by politicians, certainly in Europe, to direct the COVID-19 stimulus funds, which is quite substantial nowadays, for the green recovery? How much do you think that is a political wish or a rhetoric, or actually what is really possible technically, economically on the ground? Because you may have the money, but if you don't have the projects or the permits, etc. So how do you, as the IEA, look at that to develop, say, the green stimulus?
Yeah, and I assume you're referring to my last slide, where I was showing the sustainable debt flows and showing the trend in the first quarter. And of course, I think, you know, from our standpoint, when we're looking at clean energy transition and the investments to meet that, it really starts with the projects. So it starts with the physical investments and the capital expenditures. And then the question is how that finances that. And the interesting things about these financial instruments is that they can actually help to reduce the cost of capital. They can instill developers that know they'll be able to recycle their capital via the capital markets, and can be an impetus to invest. So that just kind of as a backdrop. In terms of the first quarter trend, I'm not sure I would say it was meager. I mean, I think it's below trend for 2019, but I don't see the fall off, and maybe it's not so apparent from the chart. But if you kind of annualize that first quarter trend, you would see sustainable debt flows at least as high as in 2018, probably a lot higher than in 2018, but maybe not as high as 2019. So in terms of the appetite for investors, and this also goes by our discussions that we've had with them, we don't necessarily see a big fall off in terms of appetite for these types of investments, these types of securities, let's say. Where we do see uncertainty is in kind of near-term risk aversion, which is characteristic of all types of financial markets. And then uncertainty over how some of the policies are going to evolve. And here, of course, stimulus programs, and I'll make a bit of a plug for an IEA report, which will be coming out in a few weeks, which is going to look more in depth at government stimulus programs and the potential response in the wake of the pandemic to support clean energy transitions. But of course, what we've seen to date has been somewhat piecemeal. So we've seen a few policy announcements. We have seen a sort of semi-comprehensive program being put forth by Europe, but I don't think it's all the pieces of that are known, or all the pieces of that have been put forth. So I think a lot of this maybe retrenchment in financial flows can boil down to just general risk aversion, but also some uncertainty as to what those policy packages are going to look like. But of course, at least in Europe, I know the authorities, they see sustainable finance as being very integral to the recovery and integral to those types of plans. And I don't see necessarily any sort of stop or rollback in policy momentum there. So I think it's a matter of waiting it out and seeing how the dots connect when some of the policy initiatives become clearer.
Okay, thanks, Mike. We have to move on, but before we do, just a very quick question following up on here. One the audience asked, as it related about the ability to repay those investments, certainly, especially in emerging economies, and maybe also in power, probably, I mean, again, in renewable side. And it could be a kind of argument that actually this crisis also forces the renewable industry to be on its own feet, purely, say, without government subsidies or other support earlier than anticipated. Can you say very briefly something on, say, the ability to repay these loans?
Yeah, I mean, it's and again, the situation can be very different in advanced and emerging economies. I would note that we've said for a number of years now that over 95% of power investments depend on some sort of regulated pricing, contracts, policies, etc. So it's not just renewables and power, which depend on instruments to manage price and volume risk. It's a number of different power sector assets. But just looking at renewables in particular, we've kind of seen a few trends in the past few years, which feed into the current crisis. One is, as the costs of renewables have come down, more governments have put policies in place. These policies have increasingly centered around competitive auctions, which have further helped to reduce the cost of renewables and also reduce the subsidy burden by governments. In advanced economies, we've seen somewhat more of a move towards exposing renewables to market risks. So either through shorter contract periods or limiting the amount of long-term contracts available through auctions. And here, renewables have been forced to engage a bit more with the private sector and look at more market-based arrangements for managing these types of risks. And the thing I would point towards would be the corporate power purchase agreement market, which has kind of evolved as the biggest source of ways to help renewables and advanced economy manage these risks outside of government policy schemes. Of course, now with the current crisis, there are questions over the willingness and ability of large corporates to start to engage in long-term power price agreements, particularly with power prices being very low. But that said, the corporate PPA market still grew by several gigawatts in the first part of 2020. So the market continues.
Okay. Sorry, so
Yeah.
I think great. I mean, in a matter of time, I really have to hand over to Karina, otherwise the panel will. So absolutely great. Thanks very much for that. Please stay online and join the discussion for the panel as well, if you can. And just a quick Menti poll for the next panel. And that's actually, do you think the Corona crisis will accelerate ESG, environmental, social, and governance investments? Yes or no? And seems to be already few people, but clear that there is a yes. And with that, what is going on, let me introduce Karina, who is our Radford, who is our moderator for the next panel. Normal life, she is a partner at White & Case, a global law firm where she leads the energy finance practice in London. With her wide-ranging experience advising international financial institutions and banks, credit agencies, etc., and developers on project financing, on structured as well, financing as restructuring, I think she's very well placed to lead this engaging discussion between our expert panel. So Karina, over to you.
Thank you very much, Wim. And it's my pleasure to be joining all of you from my garden office. So welcome to my home, I should say, to everybody online. And what an eventful few months it has been. And certainly the words transition and change are all around us in many ways. But if you can remember the world pre-lockdown, you will also recall the plans which have been set out by many oil and gas producers in relation to how they're going to embrace the great energy transition. Not all plans were alike, with approaches ranging from focus on net zero carbon emissions through to full portfolio diversification or even transformation of businesses, with others focused on making clear their achievements to date against applicable ESG standards. So it seems, therefore, what the energy transition really means may well be in the eye of the beholder, but we know that many paths can reach the same goal. So today we've gathered a prestigious panel together, drawing on different aspects of the energy transition conversation so that we can share and exchange views on this fascinating topic, with a focus on the challenges, but maybe optimistically we could pick up on some opportunities as well for the oil and gas sector in this particular area. So before I turn to introduce the panel, I would ask you please just to check the polling systems on your phones and devices. You'll be able to ask questions to the panel, which is shown here. So don't forget to do so. And as you do so, you can also vote for the other questions that have been raised by other members of the audience, if you like those questions and would also like them to be asked. So ordinarily, if we were all sitting on a stage, I would certainly take the time to introduce each of the lovely people that are about to introduce themselves. But so that we can all embrace the virtual a bit better and you can see the panelists one by one, I'm going to hand over to them to introduce themselves. So maybe Jan, I can start with you as Jan Brown, Managing Director and CFO of Pharos Energy.
Hi, hopefully you can all see me now. My name's Jan Brown. I'm from a finance background initially, last 25 years in a number of different board roles in the energy sector across renewables, engineering and consulting companies, and currently working in a small independent oil and gas company, made even smaller by the share price crashes post COVID-19.
Thank you, Jan. And Martijn Raats, do you want to go next, Martijn?
Yeah, hello. My name is Martijn Raats. I'm the Chief Oil Analyst at Morgan Stanley. I have somewhat of a dual role at Morgan Stanley. I am the main commodity analyst for oil and gas markets. So I work closely with my oil trading colleagues in our commodities division. In that area, we do all the good old barrel counting stuff, supply, demand, inventories, time spreads, those type of things. But I also head up the equity research team, and I cover European majors, the Shells, the BPs, the Totals, and the team that I lead in that area covers the other integrated smaller E&P companies, oilfield service companies. So at Morgan Stanley, we try to combine the equity and the commodity coverage very much, and I oversee that.
Great. So you're the one with all the information, Martijn. We'll be coming back to you. So next, maybe Jérôme, you could introduce yourself. Jérôme Smit, who's the chair of the executive committee of the Oil and Gas Climate.
Hello, I am Jérôme. Very pleased to be with you today. I have been for about 30 years in the oil and gas industry, a lot in the finance area, and then as well in the low carbon and gas business development areas, and as well leading climate roadmaps for various companies and leading OGCI, the Oil and Gas Climate Initiative Executive Committee, for the past 5 years. Very happy to be here.
Perfect, Shireen. Thank you very much. And last but definitely not least is Ben Sykes, who's the VP and Head of Market Development Consenting External Affairs for Ørsted's UK offshore wind business. It's a long title, Ben. I'm sure you can...
It is. Good morning or afternoon, everyone, and thanks for the introduction, Karina. I won't try and explain everything I do. I work for Ørsted. We are by renewable standards, a large player in the low carbon space. Some of you may have known us as Dong Energy. For myself, I spent over 20 years in the upstream oil and gas business. I'm a geologist by background. I moved into the low carbon space, the renewable sector, around about 10 years ago. So I've made that transition from black to green, and I'm sure we'll talk later on how we've made that transition and where our sector and our company is heading as we navigate through COVID and beyond.
Absolutely, thank you very much. So just so you know, we're going to have about half an hour, 40 minutes where we'll talk to the panelists on a few questions, and then, as I said at the beginning, you can submit any questions that you'd like to ask the panel. If it makes sense, we can pick up those questions as we go through, but we will also have 20 minutes at the end where we'll reserve some time for Q&A. So as I nodded to perhaps in my brief introduction, what is the energy in transition? And so when I think about that, I wonder whether when we think about oil and gas players meeting the energy transition, what does that really mean? And does that mean that big oil becomes, I don't know, big utilities of the future? So I thought we'd pose that question to start off the discussion, and maybe Jan, you could have a from one of the producers yourself. You could have your views shared as well.
Okay, so certainly not at the large oil end of the market, but if you look at what oil and gas companies have in their DNA, you know, we should be really well placed to move, as Benj has done, into the green space. We understand the dynamics of global energy supply and demand. We employ top-class engineers. We can manage large-scale capital projects. And we understand how to work with governments in heavily regulated sectors. So it's maybe surprising that there isn't a rush for oil and gas players to move into that space. But fundamentally, oil and gas businesses, provided they're well run and focused on the right areas, are still highly cash generative, profitable businesses. So for us, it's about focusing on assets where they're low cost, low break even, on geographies where the economics and the energy demand is growing. So there's already market for our products. And fundamentally, staying in fossil fuel industries means that we have to be scrupulous about managing our own carbon footprints in the business that we undertake. And that is obviously the area that more and more investors are focused on. I was intrigued by one of the slides that Michael put up, which was looking at the sustainability resolutions coming through from shareholders and commenting that in lots of ways they raise more questions than the answer. And I think we'll come on to that when we talk about access to financing, particularly equity capital.
So your focus, Jan, if I'm right, is on effectively greening the oil and gas business and the players as opposed to becoming power players. Is that a fair summary?
You know, there are a lot worse fuels than oil and gas, and
Yes.
Anyone who has read the statistics of the number of deaths still caused by cooking on open fuel fires inside houses, anybody who's seen the impact that you can have on the life of women in rural Asia, where they don't have to spend all day gathering firewood to cook their family's supper on, there are worse places to be than oil and gas. So fossil fuels, you know, all the statistics say, are going to be part of the energy mix for some time to come. So it's fundamentally about making sure that we are managing our carbon footprint as effectively as we can, and making sure that we're providing the transparent information about that carbon footprint in a meaningful, relevant way to all our stakeholders.
Yeah, well, we'll come back to the point on stakeholders, as you say, because you know, there's so much of this is reactive as well as proactive, I think, sometimes. But Martin, what do you think about that? How do you see the what is the energy transition in your view, and how is it possible?
Well, frankly, this is perhaps a little sobering to admit from somebody who looks at these companies pretty much all day, every day. But as far as I can see, it's a relevant question to ask, but it's not so clear. It's all a bit of a live experiment that we're going through. Look, from a very big picture perspective, the way that Wim put it to me years ago, it's simply, you know, from molecules to electrons, right? The electricity system, the energy system needs to electrify. We need to generate clean electricity, and then that's the way to sort of decarbonize the entire system. Now, if you then think of, okay, we need to move away from oil and gas into electricity generation, the traditional business model of the utilities is a very different business model from the big oil business model. Oil is global, electricity markets are very local. The regulations are very different. The returns are pretty much regulated and historically much lower than in oil. So the traditional utility business model of generating electricity centrally and then having grids so to distribute that, that is not an appealing business model where big oil would naturally move into. Frankly, to be honest, if they would all do that, it would simply be way too crowded. Now, having said that, though, if you start to think about the transition that we need to go through to facilitate this change, then you end up with electricity demand pretty much needing to go ×5. We need to not sort of double or double, but the electricity demand globally needs to go ×5. So there needs to be huge growth, and that traditional utility business model will simply not be able to meet all of that demand. So we need to move to different types of electricity generation, greener, more wind, more solar, much more distributed rather than centrally organized. So even the electricity system itself will become very, very different. Now, that means that new business models will need to emerge. Business models that, for them to emerge, need to be sufficiently profitable, and then big oil could naturally sort of step into that. But if you then really ask, what are these business models at the moment? This is a little bit of an open question. And as a result of that, what you're currently seeing these majors do is sort of like a scatter type of approach. Everybody does some wind and some solar and some batteries and a lot of electricity trading and some EV charging stations, and they buy some small utility companies to lock in pools of customers. And how all of these pieces of the puzzle are ultimately going to fit together is a bit of an open question. I would say there are broadly two strategies emerging, but even this is a very high level comment. There is a sort of strategy of thinking from supply forward. This is the approach of saying, look, we used to have oil fields, now we're going to have offshore wind, and we just generate electricity. And this is then thinking of, like, we generate the energy, and how we sell it is the next step. There are other, and I would say sort of Equinor would fit in that category. There's also another type of strategy which thinks from the customer back, thinking who are customers, retail, businesses, what are these businesses, what energy do they need, and thinking from the customer back, how can I supply them with electricity that's mostly green, say from wind, but backing it up with gas-fired power gen when the wind doesn't blow, for example, and thinking how those value chains might emerge. Now, having said that though, this is still very much dynamic, and how this is going to play out, frankly, to be honest, I don't think anybody really knows. And that's why it's also, the stock market is really challenged in valuing these big oil companies properly, which is one of the reasons why their shares have performed so poorly.
Yeah, that makes sense, of course. I mean, it's interesting what you say about changing the business models. I mean, is there not a place for the oil majors to create a new energy system model to work? I mean, as Jan said, we have a lot of capabilities and experience that is well suited, in fact, to the more advanced methods of power generation, where the oil and gas majors can actually make a critical difference, probably at a quite sweet spot, I would imagine, in terms of some of the returns that those aspects of the power industry might be able to return. Do you think that's right, Martin, or do you think we have to adapt and fit as opposed to create?
Well, look, the oil majors they're conglomerates. They do many, many different things. So there is a broad skill set in all of these companies, and in a sense, frankly, they could put a man out. They could put a man on the moon. They can, in principle, they can do almost anything. But if you start to look at where they really made their returns in the past, think of 1 billion barrels of oil, deep water, offshore Angola, right? There are literally only a handful of companies in the world that can unlock that value, right? You take 1 billion barrels, deep water, in kilometers of water depth, and then you need to drill even kilometers deeper than that. Take that oil, multiply it by $40 a barrel. There is a lot of value, and you literally have very, very few companies that can unlock those resources in such challenging conditions as where the oil resources really are. That naturally puts quite a lot of moat around those type of businesses. It's not easy to enter, and as a result, the oil majors can then have historically been able to extract a lot of return for themselves from those projects. This is not the same in offshore wind or solar parks or EV charging stations. These are businesses that are inherently much lower in their entry barriers, and so automatically the majors move from one area where they've had huge competitive advantages, allowing them to generate significant returns, into other areas where, frankly, they also have skills and they have things to contribute, but they're inherently sort of easier to do and much more competitive. So the returns are under pressure, and that doesn't mean they don't have a role to play. That doesn't mean they can have profitable businesses. It does raise questions whether you can replicate or maintain the historic profitability of these companies.
Yes, so that's your focus. I mean, I don't know, Jan, do you want to respond to any of that? It seems that some of the things that Pharos certainly does is not easy if you're bringing some of the emerging markets in which you operate as well.
I think I'll pick up on one point that Martin made, which was difficult to value these businesses, which is why they've underperformed. And, you know, my knowledge of the wind industry stopped when I stepped off a board in 2012. The company was sold. But in 2008, just after the financial crash, lending had stopped across the entire energy space. It came back quite quickly into oil and gas because the banks had enough people who really understood technically how to value these oil and gas assets. It hadn't even come back in the wind industry by the time that business was sold in 2012, partly because it was new, but because they just didn't have people who knew how to value it. So understanding how these businesses actually make money is really, really important. And I will pick up on another point Martin said. The oil and gas business is still profitable, and that is why we will stick with it until it stops becoming that and there are other profits to be made or better profits to be made elsewhere.
Well, I mean, it's a fair point, and I'd like to bring Jerome into the conversation now as well, because there are profits, but there are also green, you know, green pressure, if you like, to those profits. You know, some of the slides that Michael was showing look at the way some of the capital markets are responding, for example, to the nature of sustainable investments. But Jerome, when we look at oil and gas, and let's focus on the sort of the transition. Let's describe it as, you know, becoming the low carbon energy companies of the future. And maybe we just take a focus perhaps on the sort of, you know, net zero carbon economy and have a look at that. What do you think are the frameworks that you see working best to help the oil and gas companies become those sort of, you know, energy companies of the future?
Yeah, let me give you a little bit of flavor, and I think you will see that what Martin said in particular is quite close to what I would like to share with you. The first thing I would like to say is that the current crisis is reminding us quite usefully that when in the industry we talk about HSE, it's not about safety, which is key to our existence, our sustainability. It's as well health and environment being climate in particular. So I think the industry has been will be carrying even more strongly the HSE 3 pillars over the coming years. The second thing I would like to say, just to come back to the very good presentation we had from the IEA, is that we should keep in mind that when we talk about how the industry is shifting and will shift, we have to put on the table or around the table, not only the majors, not only the independents, but as well these 60 or 70% that are government related, the NOCs. And the day the industry shifts, it will be all the industry which will have to shift gradually, maybe not at the same speed, some before the others, but ultimately more or less all of them. And then to come to your question, it is clear that historically we have been integrated from the production part to the transformation to pushing the molecule we had or we were or we are producing to a market that was always able to absorb it. And the production part was extremely profitable because it was more and more complex, because the resource was more and more difficult to find, and because, as Martin said, there were less and less companies about to find and develop the oil that we had to produce. And the market and pushing the product to the market was not a problem because the demand was always there and was always to grow. And it was a fair assumption that as long as we were pushing the molecule to the market would swallow it. But in fact, we realize that the environment is very different. A lot of what is to be produced will probably never be produced, and therefore we'll focus, and we are focusing on what is easier to produce than before. And the market is not as hungry as we expected it to be forever. And therefore we have to be careful about the consumer, about the customer. And it's very likely that our business model will gradually evolve from this, I produce, I transform, and I push, like to Gozos, to I go and see and meet a customer, whether that customer is a city, a country, an industry, or yourself or myself. I try to understand the energy equation of that customer, to help that customer to consume or to produce as responsibly as possible with the lowest impact and the lowest bill at the end of the day, then I propose, I produce, and I supply the right energy, which is as cheap and as low carbon as possible, whether it is a mix of gas, renewable, oil, you name it. Then I help that customer to pilot it over time, to share it on the market, to produce for its neighbors, and so on and so forth. And then I take care of the circular economy value chain part of this customer's consumption. And therefore, I will try to look at its waste. And what are the wastes of my customer in this world? The first one is CO2. CO2 is a waste. The second one is fatal heat. I mean, we produce and our customers produce too much heat that they don't use. And the third one is fatal power. The more we have intermittency, the more there will be power which will not be used, which will be lost. And therefore, we will have to find ways to help our customers to valorize this, either by using them or by capturing and storing them or by neutralizing them. And with this in hand, we close the circular carbon economy loop, circle. And I believe that at the end of the day, our business models will be about that, trying to put into a logical frame what Martin has described as being piecemeal today. And the more we move ahead, the more these pieces, which are random or appear to be random today, will find their logical place in this circular carbon value chain.
It's very interesting, Jerome. I mean, effectively replacing the market with the customer, which is a change perhaps for some of the oil and gas companies. I mean, you picked up on some of the waste aspects of it. I mean, I would say the oil and gas sector has made strides in the area, for example, around carbon capture technologies. But I mean, if you look at those technologies, are they really viable in your mind? Can they really transformative in their nature, those technologies, such that will really move the dial, do you think, in terms of the low carbon approach?
I think they are technologically proven. We have the first commercial projects that are being launched, whether it is in Norway and in the UK or the US. The fiscal or regulatory schemes are being put in place in most of the key countries in the world. You may tell me that it has been on the table for the past 10 or 20 years, yes, but it has never been as present and as accurate as today. And very interestingly, the whole industry works together on it now. I mean, the industry and governments through the Clean Energy Ministerial Forum work together on it now, because now, or over the past few years, everybody has realized and agree that it will be needed. There are less and less controversy around the fact that CCUS will ultimately be business with customers and solution providers, and a cost which society will have to bear ultimately, which will be the cost of capturing, using, storing, or neutralizing CO2.
That's interesting. I mean, there's 10 years that certainly has been around, but I would agree that there seems to be a different amount of energy and collaborative energy around those technologies at the moment. Maybe we can bring Benj into this conversation. Benj, as a voice from the other side, so to speak. I think Ørsted knows all about this, doesn't it? You got it all right, right?
Well, I wouldn't want to say we take
sides. How did you do it? To explain to everybody how you did it.
Well, firstly, I don't think we want to take sides. So I guess we're all on the side of the energy transition, one way or another.
Yes.
But Ørsted, as I said briefly in my introductory comments, we started our transition back in 2012 when, as Dong Energy, we realized we needed to make some bold decisions for our business. We had already been involved in one very immature renewable technology, offshore wind, which at the time was not a technology that was on a cost basis comparable, attractively so at least, to other renewables. Over the last 8 years, though, we have seen that technology make huge leaps and bounds, and we recognized that there was an opportunity in offshore wind to build new business models. It's very interesting what Martin said about new business models, and I think, you know, one of the things that Ørsted has done is find new business models, find new ways to make sustainable, profitable business out of tackling climate change. And I think we've shown that we can do that quite successfully. I noticed that actually earlier today, our share price reached its all-time high. We floated in 2016, I think it was 17. So our business is so far proving fairly resilient to the current pandemic crisis. And I think, you know, if I look at what Ørsted has done, we have challenged ourselves around the business models that we used to employ in our oil and gas days. We've heard talk about corporate PPAs. We've heard talk about some of the challenges as well that the low carbon world will face. But I think the thing that really sort of crystallizes what we've done is we've challenged traditional business models, and I think we have found ways to drive large scale investments profitably into the low carbon space, and we're continuing to do that. And I think you know, we're not just an offshore wind company. Of course, we've got onshore wind and solar, particularly in the North American markets, and renewables is very much a global business for us as it is for many others. So there's no doubt others are following. I mean, we know Total, we know Shell, for just to name two companies who I'm sharing the panel with, are very much active in the offshore wind space, for example. So it's not as though we are out on a limb here. And I think we are going to see more and more of the traditional upstream oil and gas players moving across to a more balanced portfolio. It'd be very interesting from our perspective to see how far and how fast those moves go. And of course, as Martin mentioned, Equinor as well. One thing that's very interesting is this talk about linear versus circular sort of relationships. I think one of the things that we have seen, and who knows where this goes, is the idea that things go from one place to another. There's a flow from generating through intermediaries to consumers. Is itself, I think, an old way of thinking. We see more of a network. It's more of an ecosystem, the energy ecosystem, and I think that creates huge business opportunities. Whether it's electricity, whether it's power to X, we're very active as others are looking at where we go with the large amounts of very cheap electricity that we can now generate with offshore wind and solar and onshore wind, for example. What are we going to do with that? And the transition to a hydrogen-based economy, which will, I think, drive a lot of the remaining parts of the energy system to a low carbon footing. That whole world is a very different one to we make electrons and send them down a wire and sell them to someone. It's much more of an integrated system, and I think it's neither linear nor circular. It's more of a web.
That's interesting. And Benjamin, when you look back at and you look back from today's high share price back to when, you know, to the Dong days, what do you think were the greatest challenges in that transition then? Investors or, you know, regulators, or was it just frankly a business transformation itself that was hard to
So I think it was the business transformation. I mean, we were in a situation as a company where we knew we had to transform. So in a sense, you were leaving something behind that you had to move on from anyway. And I think the leadership at the time, you know, particularly our new CEO Henrik Poulsen, recognised the opportunity that renewables and the low carbon transition more generally was going to bring to our business. We got on the front foot because of our history in offshore wind, made some hugely bold predictions about what kind of cost reduction we could deliver as a company and as an industry, which actually we massively exceeded. And now, you know, offshore wind, as probably most people will know, is one of the lowest forms of new electricity generation that you can build if you build it in the right places. So I don't think there was any sort of magic wand there. There was just a recognition that there was a, if you like, a direction of travel for the energy space. We had some reasons to believe that we could get on the front foot with that and take a strong leading position, and indeed that's what we've done as the world's biggest player certainly in offshore wind. And of course, you know, if you look forward from where we are, I think in the world at the moment there's about 30 gigawatts of offshore wind. And to put that in context, by 2050, we're expecting well over 1,000 gigawatts. So there's a huge growth in this sector that, of course, we and many others are chasing, which brings its own questions around financing. And at the moment, green financing is pretty strong. You know, we've sold down. We traditionally sell down our offshore wind assets. We've done that repeatedly, and you know that's been a very competitive process in terms of people wanting to come into our assets. So I think at the moment, from an Ørsted perspective, we see a lot of reasons to be positive. Just picking up on a couple of things that Michael mentioned, I think one area that is of concern, particularly what we've seen in terms of investment very recently, is the transmission systems. We know we're moving towards more of an electron-based rather than a molecule-based system, and those investments that we need to see in the grid, whether it's onshore or offshore or interconnection, we really need to see that accelerate, I think, to provide the good connectivity that will make efficient markets for a clean energy system.
No, that's interesting, and you talk about investment, which I think maybe we can touch on that as well, because you know, and look at the stakeholder pressure, which is around perhaps oil and gas companies. You know, we talked about shareholder pressure, governments, financial investors, NGOs. I mean, everyone is on the bandwagon trying to push the oil and gas companies, you know, to do something. And it is exactly the time really where oil and gas companies need that investment to develop that long-term value. But there seems to be a retrenchment of financial investment in the market and the ability to get that sort of funding. Is that your experience, Jan, as from your perspective?
Okay, I'll answer that in a minute. I thought that was a really, really interesting story, Benj, and you know, an example for the industry. I'm quite often reminded when we talk about energy transition, which we all recognise is happening, we all subscribe to. There's a very famous book by Tom Wolfe called The Right Stuff, which is about the birth of the American space industry and how when they were looking for astronauts, they first went to the airline pilots who looked at the guys coming to search for them and wondered why on earth they thought that theirs were the skills that were right for what seemed like a very, very different role. So, you know, I've talked earlier about attributes that we have in our industry that could be transferred into, and you know, I can't pronounce it, Benj.
Don't worry,
Your company is a great example of how that's happened, but there will be others who will make the decision, no, we'll stick to our knitting and keep on what we're doing.
It's a very interesting point you make, actually, Jan, about that transition, because I've made it in a personal capacity, of course, going from upstream oil and gas into renewable space, and it's been really interesting learning not only what I bring across, but what I need to leave behind.
Very, very good point. So it's you asked about shareholder pressure in particular and that access to finance, and it's interesting because a question that no shareholder has ever asked me is, why are you not getting involved in renewables? They recognize that, you know, we're in fossil fuels and that's what we're going to be generating returns for our shareholders from. Picking up again on one of the points in Michael's slides where he was comparing the returns from the renewable listeds to the oil and gas listeds, he used the phrase that the renewables still lack scale and liquidity. And I would say that that is exactly what describes the independent oil and gas sector in the UK right now. We lack scale, we lack liquidity, and we've got a double whammy because we are in a very unloved sector, which is fossil fuels. So if the lacking of scale and liquidity wasn't enough, we have this challenge to get over. How do we demonstrate to our investors that we are managing our businesses in a responsible, sustainable way? We're all signed up to ensuring that the reporting I talked about earlier is transparent, it's meaningful, it's what shareholders like, because let's face it, we could all employ armies of people to generate statistics that mean absolutely nothing to the investor base. But I do sometimes question whether any fossil fuel business is just put on the naughty step and is therefore uninvestable, regardless of the rhetoric around, well, as long as you're ESG compliant and you can demonstrate what you're doing in that space, then, you know, we'll carry on providing the capital for you. So I think that's a question that remains in my mind, and we'll probably play it out for the next year or so. But one of the other points I'd just like to make is I thought the green bond, again, coming back to Michael's presentation, the proceeds of bonds where they were purported to be used for green purposes, I can see there being a massive flow to them for work that is already being done in oil and gas companies across the space, and just rebadging it and highlighting, you know, this is what we're doing. If that's what you need as bond investors to lend to us, then, you know, judge us on what we're actually doing. So it is a challenge. Are we on the naughty step just because we're in the industry, regardless of what we're doing for ESG, or are there going to be differentiators? And if we are on the naughty step, sooner or later, the challenges to the underlying valuations of those businesses is going to push them into other ownerships, and those other ownerships may well not have the same regard for ESG concerns as the public capital markets.
Yeah, that's interesting, Jen. There's a question that's come up from the audience for you, which I might put to you now before I turn to the other panelists, because I think that the pressure is somewhere between the returns, of course, that the investor bases want and expect from oil and gas companies, and the need for investment to generate a greater long-term value proposition for those companies. And people can come together and they can create pressure somewhere in the middle, which means that there's a sort of retrenchment of investment that allows oil and gas companies to keep up the returns and make the investments. And one of the questions that has been put to you by the audience perhaps is saying, do you think your shareholders would accept having smaller returns in relation to your developments by implementing carbon capture technology if it shored up long-term viability? So do you think shareholders would take the hit now to develop the long-term value proposition?
I think that is the $64,000 question, and I would love to answer that. Yes, they would. And I think there are a handful of them that would really mean it when they said it. I think there is a lot of short-termism in the public capital market still.
Yeah, I think that's one of the challenges. And maybe turning to Jerome or Martin, I'm happy to take either of you on this one. You know, looking at this sort of challenge between what people want in the next 12 months versus what the industry actually needs by way of investment. I don't know, Jerome, you've talked about, you know, creating this economy going forward. That takes money, doesn't it? And where's that money going to come from if everyone's on the naughty step?
Yeah, let me answer that. And just before, I would like to say two things. The first one is that what is interesting about stakeholder pressure today is that unlike 3, 4, 5 years ago, the pressure coming from civil society is going into the same direction as the pressure coming from shareholders. So shareholders and civil society are converging in terms of what they are asking for. When 2, 3, 4 years ago, the majors, independents and so on, were receiving conflicting signals from civil society on one side and shareholders on the other side. So what I'm describing will help a lot these big companies to concentrate their financing resource on what matters to succeed on their energy transition roadmap over the coming 20, 30 years. Hence what the majority of them, at least in Europe, has been announcing over the past 6 months to 1 year. This is the illustration that now, to some extent, the market is mature. Everybody is speaking from the same voice. That's the first point. The second point is that we nevertheless have to keep in mind, and I will repeat what I said earlier, one point, which is not all the major oil and gas companies have the same stakeholders. And the stakeholders of CNPC, Aramco, Pemex, Petrobras are not the same stakeholders as those of Exxon, Shale, BP, Total, Chevron, and so on and so forth. And if we want to change the industry progressively, we cannot change one part without changing the other part. And therefore, the value proposition has to be right for both parts. And the third point I would like to highlight is that I believe that the market will want to finance this energy transition, and will want to finance it from where it is likely to come from, i.e. these big energy, oil and gas companies. Why so? Because at the end of the day, it's not only about producing molecules are producing electrons, which might be easier than tomorrow than yesterday for the reasons highlighted by Martin. It's about managing complexity. The more we will enter into this complex circular carbon value chain, customer management, and so on and so forth, the more the industry will have to manage a set of competencies that are new, very complex, very imbricated. And the value will be extracted by this complexity or from this complexity more and more. And the second thing is that to be successful, the transition will need scale and will need multi-stakeholders approaches and will need strong competencies in terms of managing impacts. And the oil and gas industry is uniquely positioned to handle this dilemma or trilemma.
Oh, that's interesting, Jerome. Martin, do you want to comment on any of these things? I mean, do you think that the oil and gas players are no longer going to be the largest dividend players in the FTSE? Do you think it's going to move to a different world?
Well, in the 1Q earnings season, several of them put themselves rapidly on the trajectory of indeed not being the largest dividend players anymore. It's been truly astonishing that in the month of April, we both had negative oil prices and dividend cuts from the likes of Shell and Equinor. I mean, Shell has not cut the dividend since the Second World War. So that's a true sort of statement, I would say, on behalf of the management of where they are seeing their future earnings power. Now, look, the issue of financing is very important for the issue around sort of the energy transition and particularly the majors. And the issue is this: if you look at the Ørsted share price, the Ørsted share price, by many metrics, is very, very high. Now, any share price reflects two things. It's the expected future earnings trajectory, discounted at a discount rate that is appropriate for the business, reflecting the riskiness of that business. And in the case of Ørsted, not only are investors generally saying, we think there's a lot of earnings growth, but they're also saying, like, these earnings look to be very sustainable. And we understand the business model. And therefore, this is not such a risky venture. We are willing to discount these strongly growing earnings also at a very competitive discount rate. Now, any company that wants to undertake a new investment project, say an offshore wind project, needs to look at what will the return on that project be and compare it to its own cost of capital. So if you're Ørsted and you have a very high share price, that equation is simpler. You can, it's easier to invest shareholders' money if your investors are telling you the returns, the required return on your business is relatively low. Now, if you then look at all of the majors, the Shells, the BPs, the Totals, Exxon, Chevron, that group of companies, they're largely in the same category. They are still overwhelmingly oil companies. And the oil industry looks risky. Out of the 5 major oil price downturns in the last 40 years, 3 have happened just this decade. It's difficult to guess prices. It's difficult to guess long-term demand. These have turned out to be very volatile businesses. And people question what the long-term sustainability of these business models are. So people say, look, I'm willing to invest in any of these majors, but my required rate of return is very high. I need to be compensated for that risk. Now, if then any of these majors say, I want to transform my business and I want to move to these renewables and be more like Ørsted, then the majors will need to look at, say, an offshore wind project and say, hang on a second, my investor's telling me that my cost of capital, still mostly an oil and gas cost of capital, is quite high. So therefore, majors bidding on new renewable projects, they do so in a very handicapped way because their investors demand that they generate higher returns of capital. And there's a real question, and this is a financing question, can a major build out a renewables portfolio, a renewables business with an oil and gas cost of capital? And increasingly, I would say that answer might well be no. That is a really challenging issue. So what you then hear is sort of, and we've written research around this, and I think this is an active debate, say, should the majors collect all their renewable businesses and put them out in a sort of separate entity that it can have its own stock market listing and attract its own set of investors that mainly want to invest in a green, growing business And that set of investors is fundamentally different from the current shareholders of these majors, which they bought shares in mature cash generating businesses paying out a lot of dividend. And when you start to mix up these different business models and have to attract different types of shareholders, it all gets a bit murky. Should you just separate that and make that into a separate company? Now, look, that has all of its issues, but the main issue that it's going to be very, very challenging to build a material renewables business with an oil and gas cost of capital. That is one of the key critical issues that the majors will need to navigate over the next couple of years.
Absolutely, and the model that you're describing there obviously has been taken by some of the majors in terms of their investments outside their main business. We know that BP has done that, or in the acquisitions ultimately of businesses, which I'm sure plays on Benji's mind as well sometimes, because they're attractive propositions out there, right? In terms of the acquisitive majors out there who might seek to get there. I don't know, Benj, I'm only teasing you, but
no, well, that's all right. We're safe for the moment with our. We're fine with our shareholder structure at the moment, as I'm sure Martin knows. But absolutely, and I think this is a really interesting question. Of course, for Ørsted, we moved lock, stock, and barrel from upstream oil and gas completely out. So we didn't have this kind of question of what is our cost of capital when you have two different elements in your business that have very different profiles and different appetites for risk for investors. So I think it's a fascinating question, and I'm watching with great interest to see what you all do.
Yeah. Well, thank you, everybody. I'm conscious of time. I want to fit in a couple of extra questions that have come through from the audience, and maybe, Benj, I'll stick with you with one of them, and then perhaps I'll address the other one initially, at least to Jerome. There's a question here about the cost of investment in transmission systems.
Yes.
Because, of course, ultimately, it isn't just the electrons. There's lots of stuff that goes with that, as you rightly said, in terms of your description. So, I mean, who should cover that cost? Electricity suppliers, customers, governments? Where does that sit?
Well, that's a really good question. I think it's very market specific. So, I mean, as we saw from Michael's graphs, it's a sector of the energy infrastructure that is heavily in the public ownership space, and I don't necessarily see that changing. But I think there's a difference between how things are funded and how things are delivered. And I think what we see, my own experience in offshore wind, we see great efficiencies where there's a competitive space for offshore transmission, for example. That's not the same as saying that all needs to be funded outside of the public sector. And I think, ultimately consumers pay, and we need to look at what delivers the best value for consumers. And that varies from market to market as well. I think the other perhaps more interesting point on this, though, is that we talk a lot about shifting electrons around, but we're seeing rapidly emerging a hydrogen economy. And this idea that actually maybe we want to start shipping around molecules, they're just not fossil fuel molecules. And whether that means using hydrogen for transport, hydrogen for industrial processes, I think we will see hydrogen and ammonia as a product of hydrogen as really interesting ways in which we solve not only the variability and non-dispatchability of renewables, but also this question of transmission. And there is a big race on, and many of my competitors on this panel are active in it, pursuing hydrogen as if you like, the next big thing after offshore wind. And I think as renewables penetration grows, and there's if you like, capacity to use generation that's otherwise not going to be put to good use, then hydrogen becomes a really interesting proposition. And of course, there's more than one way to produce low carbon hydrogen. We're strong believers that using renewables and electrolysis will deliver clean hydrogen in the future, and I think that will be an important competitor to wires, if you like.
Mm-hmm. Yeah, absolutely. Well, perhaps then just to thank you for that, Benj. I think it's an important point. The sort of the midstream power sector is certainly competitive, and we see a lot of that in the transmission projects that come across our desks at my place as well, certainly, and around the offshores, for example, in the UK in particular. Changing tack slightly, and maybe Jerome and Jan, we're going to come back to this question about the sort of net zero landscape, because people are focused on transition being, effectively standing up to the ESG standards, as you were talking about, Jan, and frankly, reporting on those properly is clearly part of the challenge, but also the actual transformation of certain technologies. But Maybe, Jerome, if I can put it to you first, how have the BP and Shell commitments on Scope 3 emissions changed that net zero landscape in your view?
You know, I think that the first thing which is interesting is that all or most of the big oil and gas companies are trying to make sure that they do the things properly. They start with their methane emissions, they go to their scope 1 and 2 carbon emissions, they make sure they reduce it, they reduce them. Some of them are making commitments to bring them to zero or to net zero over time. And then some of them are as well committing or engaging or having ambitions on scope 3 emissions, one way or the other one. And I think the most interesting thing for me here is that 5 years ago, this was not on the screen anywhere. Then it started. And my conviction is that it's only the beginning to some extent. Is that what some companies are doing will be followed by others, by many others. And what some companies have started to do, they will improve it gradually. And you cannot ask such big companies to change in 6 months or in 1 year and to shift completely the way they look at their business models or the way they look at 30 or 40 years from now. But you can see, if you analyze what these companies have been announcing year after year over the 3, 4, 5 last years, that they are gradually shifting like big, big tankers. And that, but ultimately, the direction of travel makes no doubt. So this is what it inspires me, which is very often when you listen to stakeholders or shareholders, either they applaud or they say it's not sufficient or we are not yet there or it's not perfect, but they don't, many of them don't understand that it's not, we are at the final point yet.
Well, perhaps we'll leave it there with that analogy of the slow-moving tankers sticking with us as we move towards the energy transition, a positive one and a nice one. And I want to thank you all very much for joining me virtually today for this panel. If I was on stage, I'd shake your hands, but you can take it as a virtual shake of hands and wave anyway. And I'll hand back over to Will to close down the seminar. Thank you.
Well, thanks, Karina, and thanks, panelists. I mean, and also our keynote speaker. I mean, this was a really rich discussion, and I think also pretty directional. I think. I mean, just I think the general consensus of that the COVID will accelerate the transition. How exactly we don't know yet, but there are some ideas around it. Probably we'll just find our way. So thanks everyone, and really also for the participants. We have one final question to that, and that's basically is what are the key messages you will take away from this webinar. It's just an open forum, so you can just put your keywords there, and just also this kind of feedback for us, right, what people really took with them. In the interest of time and to be able to close on time, I will just let this go in the background, but also I'd like to draw your attention to the questionnaire also be sent out by the Energy Institute to say what you thought about this webinar format and how it all went, etc. So please do that as well. And then I think just about in the right timing, once more, thanks everyone and have a good day.